We've got two gentlemen here from Oxford Economics that will be presenting on all the tools and value that they provide through our partnership with them. As a quick housekeeping item for everybody, we're asking people to please mute their microphones and to also turn off their cameras. For anybody that has any questions, you can use the chat function. If you'd like to ask them verbally, we're going to be taking questions at the end of the webinar so that Jeremy can present his material. As a quick introduction, we've got Timothy Warren. He's the Director for Canada and VP of Business Development. He really handles the Canadian market for us and is our contact here in Canada. We also have Jeremy Leonard here. He's the Managing Director of Global Industry Services, and his team is responsible for all the forecasts and documents that have been shared with our team. So I'm going to stop sharing here and then let our Oxford guests share their material. Thank you.
Great. Well, thank you very much, Vincent. Appreciate that. Yeah, so I'm Tim, and it's great to be here. I'm not going to be talking a whole lot. What I'm going to do is give just a brief intro to Oxford Economics, who we are, just in case there's some folks out there, and there likely is, who doesn't know who we are and what we do. And then we'll turn it over to Jeremy, Jeremy will speak to the stuff that you really came here to listen to and hear about. So if we move forward in a couple of slides here, Jeremy, so just the next one, we're going to spend a bit of time right here, I suppose. Every time I talk about Oxford, I do it a bit differently, but just in brief. So to throw some numbers out, we are the world's largest independent economic consultancy firm. We have a number of folks all over the world, which we'll touch upon in just a second. But in brief and very high level, what we do is we really look at a lot of different markets, 200 countries, 100 different sectors, over 8,000 cities and regions in substantial detail, and not just from a forecasting perspective with data and things like that, but because we have this great group of people around the world, we provide a lot of insights, research briefings, data insights, country reports, etc. But if we had to boil it all down in terms of what Oxford does, is we really help our clients gain a better understanding of what's happening in the marketplace, the complexities, the uncertainties, to really help folks make better, defendable and informed decisions. And that's really what it all boils down to at the end of the day. All right. Part of the way we do that is, as I mentioned, our global reach. You see there that we have 350 economists and analysts globally. There's over 500 now with Oxford. A number of different offices around the world. Our head office would be in London, and for the Americas, it would be in New York. We have a larger one in Australia and South Africa. The other ones are similar to the Canadian office, and actually the picture in behind there is the building we're in. So I'm on the 9th floor of that building. That's at Islington and Bloor. Here in Toronto. And we've got a team here. We've got some economists look at the macro environment. We have a consulting group that looks mostly more at the provincial, and then our supporting team that supports our clients here in Canada. So that's kind of in a nutshell what we do. If we move to the next slide here, I'll just cover a couple of things. I'm not going to go through all of this at all, okay? We're going to focus on the industry in just a second, but I just want to highlight a couple things. Obviously, I mentioned the countries in the forecast, and I mentioned earlier helping to understand the uncertainty of what's happening out there. We do a great job with alternate outlooks with our scenarios as well. So what we do is we forecast out, whether it's industry or otherwise, but then we wrap around it what could happen with different scenarios. So what could happen if there's a continued escalation in the Middle East or the Taiwan-China tensions. I'm quite certain we're going to have a Biden-Trump scenario as well again, which we did a little while ago. So it's just good to know all this, and I just put it in there for folks to read later, and we do a nice job wrapping the climate and different scenarios about our, how close we can actually get to net zero, and iteratively along the way, what impacts that would have on the economy and various parts within it. So if we move on to the next slide here, this is just where we're going to focus today. Jeremy's going to take over in 2 seconds, but you received the Canadian Industry Forecast Report and information. And again, we're going to dive into this in a moment. The next slide I'm not going to talk to. So we can go to the next slide, but I know I wanted to include it because this will be passed around. Aside from the off-the-shelf things that we provide and the reports and so forth and the data, we do obviously a lot of custom work for folks as well. So I'll leave it at that, and then we'll turn it over to Jeremy, which really heads the industry service globally, and then I will put my phone on the mic, mute, and let him speak. So.
Great, thank you very much, Tim. And it's really nice to speak with you all, especially being someone who's an American who immigrated to Canada in my mid-20s, and now I find myself over in London. I was just joking with Tim about it's hard to find a place out in the middle of nowhere here in England. So I'm very pleased to be talking to my adopted homeland. So I think it's a good introduction. I'm going to do two things here. I think it's worthwhile to talk to you a little bit about the current economic conditions with a focus on Canada, just so you can see what our current thinking is, and I think it will help kind of give you some background and color to the materials you're getting. And then I want to spend a little time just talking about what you get at the moment, because we at Oxford Economics are really keen to make sure that our clients are getting the most value out of what they're getting from us. And so I'm going to talk a bit about the materials you're getting, how they can be used, how we actually use them in certain contexts to deliver more value to other clients, and hopefully you'll come away with some ideas about how you can use the resources at your disposal in more effective ways. So I'll just start with the economic overview, because I think it's quite important. As Tim mentioned, there is a lot of uncertainty out there. I think the main message, certainly from our forecast, is that we are definitely expecting a weak start to this year. I think one of the things to bear in mind is that last year was actually quite a lot better than we were expecting. You can see over the chart on the right-hand side, you can see actually that recession that we were kind of fearing in the advanced economies as monetary policy authorities tightened interest rates actually didn't happen. And we can see the advanced economy bar there really didn't get that small as we went through 2023. But as a counterpoint, it's actually not going to get any bigger. In fact, it's the contribution to global growth on a sequential basis is actually going to get a little bit smaller. And what's driving this is fundamentally the delayed impact of monetary tightening. I think what happened and what surprised us as well as a lot of forecasters was in 2023, drawing down of pandemic savings, various other idiosyncratic factors actually help sustain the economy. With those factors petering out, we're now going to get the full brunt force of the monetary tightening. And so you can see the sequential momentum on the left-hand side. What you're seeing there is quarter-on-quarter growth rates. So sequentially, how will that growth accelerate over time? And you can see it really isn't until the beginning of 2025 that we start to see any meaningful acceleration. I think another point that's very important is you can see the contribution of China is it will remain quite small, certainly very small by historical terms. We could talk all day about that, but it's a fundamental shift. China is really no longer the motor of global economic growth. Turning over to the right-hand side chart, it just sort of positions various countries in quadrants, and what this is showing you on the vertical axis is basically the growth in GDP benchmarked against its average just prior to the pandemic. So is the economy growing faster than it was before the pandemic or not? And then on the horizontal axis, you have what is the actual GDP growth rate in 2024. So of course, where economies want to be is up in this upper right quadrant, and you can see there aren't that many of them who are there. We have a lot of countries who are experiencing positive GDP growth and are expected to in 2024, but that growth is going to be subpar compared to prior to the pandemic. Now we'll come back to Canada because you can see Canada is a bit of an outlier. You can see that, not only are we expecting 2024 to be a virtually flat year in terms of GDP, obviously that's significantly below what we were seeing before the pandemic. So the recovery from this period of slowdown is likely to be protracted. Of course, one of the main things driving what's going on in the economy is inflation. And the good news is that the impacts of monetary policy changes do seem to be having an effect. Global headline inflation has dropped very, very sharply, as you can see on the left-hand side. This is now looking at a group of countries, both emerging and advanced markets, and it's showing you the interquartile range, which is basically between the 25th and 75th percentile, so eliminating the outlier countries. And you can see that the median, so for advanced economies, has actually come down to below that 2% target, which is obviously what most central banks around the world are targeting in terms of inflation. Now, part of this is being driven by one-off factors like falls in energy prices. So we don't think that we should infer that monetary policies are going to be quick to reduce interest rates. And certainly if we look at the Canadian example, I think the right-hand side chart kind of illustrates it. You can see that this kind of core inflation measure here, this is what concerns the monetary authorities, because this is really measuring fundamental price pressures in the economy. And you can see that that is still running a fair bit above the Bank of Canada's target range. And you can see that, one of the things that's keeping that high is the impact of the costs of housing. So if we look at the mortgage interest cost, if we exclude that, you can see that inflation is quite low. But of course, that's a big part of households' budgets. And with interest rates high and refinancing continuing, you can see that it's going to be a while before we think the Bank of Canada is going to lower rates. Indeed, this just gives you a snapshot of our thinking in terms of when monetary loosening is going to start. On the left-hand side, you can see some of the Fed, the ECB, and the Bank of England. We think the Fed is going to start things off in May time, possibly June. And indeed, the ECB is likely to start reducing sooner. The reason for that is prices have come down fairly significantly, due in part to falling energy prices, but also to broader supply chain pressures that have eased considerably. I think in Canada, the issue is that our baseline for the Canadian outlook is for the recessionary conditions that we're currently in to persist for a couple of more quarters. Now, with the experience of the U.S. in terms of the ability to avoid a protracted period of weakness after monetary tightening, it may be the case that we see growth pick up more rapidly than we would expect. And so we have modeled a scenario where we sort of hypothesize a soft landing for Canada, that we would see GDP growth increase quite significantly more than the kind of flat to slight declines that we're expecting early this year. Well, one of the side effects of that will be to increase inflationary pressure. So paradoxically, if we have a soft landing scenario in Canada, there actually is a risk that the Bank of Canada may actually tighten a little bit to ensure that inflation comes down to the comfort range. So I think there is some upside risk in Canada in terms of where interest rates might be heading over the near term. I think if we look at industry, because of course this is the part that's most important to CFPA members, because it's going to drive a lot of the investment in the products and components that you're manufacturing. And you can see for industry, you can see that conditions have been quite weak for some time. If we look at the left-hand side chart, which is comparing the hard data of global industrial production looked at on a month-to-month growth rate, a sequential growth rate, and then overlay the manufacturing PMI, which of course, as we all know, is a survey-based indicator of near-term forward-looking market conditions. So you can see, interestingly, that industrial production has actually started to improve over the last few months, even though the PMI has remained in negative territory. Part of what's driving this is the dynamics of supply chain pressures and backlogs, because you can see this period immediately following the pandemic. The PMI was very, very high. We all remember demand conditions for goods and manufactured goods in particular was very, very strong, but we had supply constraints. So the actual product coming out the door was much weaker than the PMI was suggesting. Now we're seeing a little bit of the flip side of that now because part of what's driving industrial activity today is actually backlogs of orders that were built up during the period of supply chain pressure. And that's especially true in the machinery sector, which has very long lead times. If we look at the same information in a Canadian context, you see broadly, broadly similar trends. And you can see that they are arguably more pronounced in that the supply chain pressure certainly had this gap between the survey-based PMI and actual industrial activity was very, very wide. And we can see the same general pattern here. Industrial production has started to tick up. Unfortunately, the latest data just came out today, and I didn't have a chance to look at it. But you can see the PMI is actually now starting to move in the right direction. So this is providing some signals that in terms of the industrial economy, we should start to see a recovery. But of course, all is going to depend on the impact of interest rates. This just shows you our current forecasts for industrial production. I think there are a couple of key points to make here. Of course, we'll focus on Canada here in a second, but I think what's quite interesting is that last year was really the low water mark for global industry. You can see just 1.1% expansion last year, and you can see that was heavily concentrated in Europe. And this is underscoring the impact of those sharp rises in energy prices following the start of the Russia-Ukraine war that had a huge impact in Europe in particular, which was very dependent on Russian gas. So you can see big decline in Europe. The countries that were more shielded from those energy price shocks, like the US and Canada, which of course, as we know, have abundant domestic natural gas resources, were not really impacted by the price gyrations, saw a better performance. I think if we look to this year, you can see, basically at a global level, we can see 2.9% growth. That's actually quite a good acceleration. But what's interesting is you can see that most of that is really happening in China. You can see that we actually are expecting, notwithstanding what I said a couple of moments ago, that actually we are expecting to see an industrial acceleration in China. And this is being driven by the government's concerted efforts to try to stimulate growth with the old playbook of investments in infrastructure, debt-driven investments in heavy industry, power infrastructure, et cetera. We don't think that can be sustained, and you can see the cost of that growth that we're likely to see in 2024 is actually significant declines in that growth rate as we move out into the medium term, because we don't think the policy response of China is sustainable. But coming back to the developed world, you can see, very tepid growth in the U.S. This is ascribed to some pretty strong activity in oil and gas production. Also, the impact of stimulus programs such as the CHIPS Act and the Inflation Reduction Act are stimulating investment and activity in certain sectors of manufacturing. I think Canada, as you can see, it's going to be a tough year for industry. For the year as a whole, a slight decline. What that's masking is weakness right now that's likely to persist through the middle of the year. As we move towards the end of the year and those financing costs start coming down, as we expect the Bank of Canada to reduce interest rates, then we should start seeing a sequential acceleration. So you can see we should be moving to modest growth as we move into 2025. So I wanted to turn right over, and I realize that's been a whirlwind tour of the economy, and I'll be very happy to take questions at the end, but I did want to spend some time speaking to you about getting the most value from our analysis. And again, just coming back to the point I wanted to make, it's really, really important for us for our clients, one, to be happy, but two, to be able to use the information in a variety of different applications. So I just wanted to show you what you're probably, hopefully, already familiar with. The title page of the chart book that you receive once a quarter from us. So, I mean, the most important thing where I start is actually down here at the bottom, because it gives you a quick visual view of what's happening across the key sectors, and the coded arrows you can immediately see. This is showing you, it's basically showing you, what the current year is going to look like relative to last year. So right off the bat, you can see the sectors that are important to you. Do I need to be thinking about increasing capacity, cutting back? What are going to be my CapEx plans, et cetera? So a quick visualization gives you a first picture, but then of course, you're probably interested in saying, well, what's, we see this transport equipment. What's the broader context? How fast are these sectors growing compared to one another? Where are we seeing trends sort of in the history and in the forecasts? And, interestingly, you can see here in transport equipment, we had 2 very, very strong years. This was driven by the reduction of supply chain pressures, the increased availability of semiconductors. So a lot of this demand here was essentially backlogs that had built up in earlier years, and then you can see shouldn't be a surprise that that's going to come down this year, but that really is more of a cyclical adjustment to a one-off shock, because you can see actually looking further out, the forecast for transport equipment is actually looking quite good. And in fact, that's, part of that is driven by the aerospace sector, which is very important in Canada, which is continuing to recover from its post-pandemic collapse. So this very quickly can give you a sense of the relative growth importance. You can then also look and see, either in this table or in this pie chart, how important are these sectors. So if you're looking at manufacturing, well, what's driving growth? Well, it could be that a sector is growing very rapidly, might be a very small share of activity. So it gives you a sense of, how to place these sectors. And then, of course, the other thing is that we always want to benchmark Canada against the world and see how things are going. And you have this chart that shows total industrial production, and you can see that, not surprisingly, Canada is underperforming. And this does come back to the points I was making earlier about pressures in terms of high interest rates, persistent inflation continuing to eat into households' finances. And I guess, something that's more Canada specific is what's going on in the housing market, and just the costs of housing, that's actually adding an additional layer of complexity to the inflation question. But over the medium term, you can see, quite interestingly, we do think that Canada will remain competitive as an industrial manufacturer. You can see that Canada growth rate, it's a little bit lower than the world average, but considering that the world includes a lot of up and coming emerging markets, that's quite a respectable performance in the medium term. And then, of course, we have the forecast highlights, and you'll notice that this is quite descriptive. It's essentially telling you, what are the key drivers of growth across manufacturing and the extraction sector, and even a few comments on the service sector, which, although it's a kind of peripheral sector to your core areas of business, there are quite a few service sectors who are heavy investors in machinery, et cetera. So it gives you a kind of complete picture of the what the forecast is about. Now, I'm sure that some of you will look at these forecast highlights and say, this is all very interesting, but it is very descriptive, and it is kind of, it tells you the what, but not the how and the why, and that's something that we're going to change in the next report. I can't show you the report yet, but we're essentially going to do a significant expansion of the Canada Country Report that you're currently getting, so that rather than having this title page plus a series of charts and tables, we're actually going to take all of these headline sectors and a few more, and we're going to expand the analysis and do a deep dive into every single one of those sectors. I'm showing you here an example of the one for the United States. The one for Canada is going to look very similar in terms of the style of analysis. It will begin with an overview page. So in addition to this information, which will not be removed, you'll get more of a narrative, not just the what's happening, but why is it happening? What are the economic forces to help you connect the dots to what's happening in terms of the macroeconomy, what's happening in terms of energy prices and other things that are going to impact industrial activity. And that's all spelled out for you in bullet point format. We have a quick summary of what the key economic drivers and constraints are, so that you can very quickly get a handle on what's going on in industry and what are the factors to watch out for, to look for changes and turning points. And then for each of the sectors, I've just shown construction here as an example, but just to reiterate, for 14 goods producing sectors, you will see a slide similar to this, a quick overview table of the forecast, a couple of key tracking charts of the high frequency indicators that are important indicators of market conditions. And then the important part from our perspective is that here you will get a much more in-depth analysis from my team of 25 sector specialists on what is driving activity in Canada, in terms of, to what extent are interest rates more or less important than price movements, the effects of inventory cycles, because many of us know there are sectors like the chemical industry and the steel industry where there's quite a bit of stocking and restocking, which can impact short-term demand conditions. And again, for each of the sectors, we will have a similar section that will tell you the growth drivers and constraints. So, for instance, it's clear in construction, the infrastructure bill and the Inflation Reduction Act are having a big impact in terms of building some of this new power infrastructure. And of course, as an interest-sensitive sector, the path of interest rates is also a big factor. But each of the sectors will have analysis similar to this, which we hope will sort of enrich your understanding of the numbers that are included in the report. And the other thing, of course, that is accessible to CFPA members is our data bank. Of course, in the report itself, you'll know that we do have very detailed tables that are going to show you output growth trends for all of the sectors that we cover, as well as a number of other metrics, both in the short term and into the long term. But of course, a lot of people will be interested in visualizing the data. So we have an online data platform. So indeed, all of the numbers that are in the printed report and many, many more can be found in our data bank. So for instance, in the report, the indicator we focus on is value-added output, so the amount of production in the sector. But in the online data bank, you will find for all of the sectors that we cover, you'll find not only production, but you'll find top-line sales, you'll find profits, and you'll find investment. So it's a very powerful tool. You can very quickly download data to calculate, for instance, profit margins. You can look at output. You can look at investment output ratios to get a sense to benchmark that, to look at what investment patterns might be. So there's just numerous ways to do this. The platform itself has the ability to draw charts right within the platform, which can be useful for quick analysis. But we find that most of our clients get the most value by selecting a certain data set, downloading it into Excel or R or whatever platform you like, and undertaking some additional analysis. The advantage of the platform is that you can save your selection, so that each quarter, when there's a new update of data, you can just go in, you can click a single button in your Excel by using our Excel plugin, and be able to access that data instantly by the click of a button and be able to continue with your analysis. So, I would really encourage you to use the data set, because the numbers that are in the report obviously are very interesting. They tell you the story of what the forecast looks like and why. But one thing that I think is important is being able to use the forecast to tailor them to your particular market conditions. Now, what do I mean by that? Well, when you are thinking about demand for your products, fundamentally, it's going to be a function of the economic activity in the sectors that you're selling into. So if they're doing really, really well, they're going to buy more. If they're doing not very well, they're not going to buy so much. So we basically take this principle and we use our own data for a report that we actually do for your sister organization across the border in the US. And what we do is we create an indicator of hydraulic and pneumatic sector demand. So essentially a market barometer for what demand is looking like in sectors that are using hydraulic and pneumatic power products. How do we do that? Well, we take our sector data. So all this data here in this table is coming directly from our data bank, and you have access to all of this data here. And what we're doing is we're basically aggregating the growth rates and we're aggregating them according to the relative importance of the subsets of each sector, their importance in each of these. So for instance, we all know that construction machinery and ag machinery, very heavy users of hydraulic equipment. So these are going to have ag machinery and mining construction equipment have very high weights in here. And so I guess what I'm trying to point out here is, one, this is some analysis that potentially could be useful for the CFPA and its members, but given that all of the members have access to this information, it's actually possible for you as an individual company to go in, take the data, because you're going to know what sectors you're selling into better than we do, and you're going to be able to weight these growth rates for the sectors that are important to your sales, weight them together, and that's going to give you a pretty good barometer of what market conditions are going to be like. And from our data bank, you'll have a forward-looking view, not only of that synthetic indicator, but which particular sectors underneath are driving that growth. So this is something that a lot of our clients do. We do it, as I mentioned, we do it for our clients at the National Fluid Power Association and many other associations. And I would encourage all of you to think about this, because it's a way to add additional value to the numbers that you already have access to. And I think that was all I wanted to say. I will leave this up, and I'm very happy to take questions. I'm going to have to ask somebody else to monitor that, because I can't see who's raised their hands. But like I said, I'm very happy for you to unmute yourself and ask your question orally. If you'd like to leave it in the chat, that's fine too. But I'll stop there and open it up. Thank you very much.
Jeremy?
Yeah.
Yeah, so John Mason here. Just curious, does the extraction component break out into 3 different sectors like mining, oil and gas, and forestry?
Yeah, it will, in our data bank, it will decode to, well, there'll be ag, forestry, and fishery as one sector, and then there will be mining divided into oil and gas, coal, and then what we call other extraction, which is essentially metals and quarrying. So there is some detail underneath the extraction headline.
Okay, so I noticed extraction had an arrow as a negative growth on that front slide, but
Yeah.
just curious if mining, with China being a big driver next year or this year, maybe iron ore will be on the up for mining.
Yeah, I think you can look. I mean, you can infer some of these things from what's happening in, for instance, steel markets, because unfortunately our data doesn't allow us to know in that extraction what proportion of it is iron ore. But you can infer that information by looking at steel production trends, which we do track, and certainly in the U.S. we're expecting a bumper year for steel production next year. China, I'd have to look at the numbers. So that's the way you could sort of get some visibility on what's happening in terms of iron ore. And I wouldn't disagree with you that there could be some upside there in China, given their efforts to stimulus.
Great. All right. Thank you.
Yep.
All right, so if there are no other questions, we'll take this moment to thank everybody for attending this webinar today. Thank you to our guests from Oxford for presenting on Oxford economics and the tools that are currently available to our members. You'll see on my screen, we do have our annual general meeting coming up in June. So for those of you who are interested in attending, please, the early bird registration will close shortly here, so you can register online. Also, for those of you who aren't aware, this specific webinar was hosted by the Market Insight Committee. For the CFPA, we collaborate together between organizations to provide information similar to what Oxford does, or in collaboration with what Oxford does. We are looking for new committee members, so if you're interested in attending, please let Trish or myself know. We're also looking at doing a distributor in-depth report. So for people on this call that are distributors and have the surveys waiting in your inboxes, please fill them out. We'd love to hear your thoughts on the value that would create for your organization. And we also have as a piece of information for our members, Oxford will be attending the AGM as well, providing some assistance with roundtables and also providing a keynote speech. So thank you everybody who attended today. We really appreciate your time. And
Hey, Vince, sorry, just
Yeah.
had one question. How do we access the report, or are we getting a copy of it sent to us?
It's going to be available via the member portal on the CFPA, and I believe somebody at Wayneby has access. If you're curious to who we can, I can circle back with you after this meeting, and once I find out who has access for your organization.
Okay, thank you.
Yeah, all the Oxford reports are housed on the members only section of the website. If anybody doesn't have access, just drop me an email and I can get you set up. Once the webinar has been fully recorded, I will also post that to the members only section of the website. If you are interested in a copy of the slide deck, please also let me know and I will happily send it over to you.
All right. Well, thank you, everybody. And,
For the distributor members on the line, I did just put up a link to the survey. It would be wonderful if everybody could complete it so we know not only what your wishes are, but your capabilities. And thank you to everyone involved.
Thank you.
Thanks for having us, Trish and Vince. Really appreciate it. Very nice talking
thank
to you all.
We look forward to hearing from you again.
Great. Thanks, everyone. Goodbye.
Bye now.
Thank you.
Bye.